question is, we have seen where the US equities market has went up 12.8% last week, and it's about 20% up from latter part of 2008. So if market has gone up 20%, but long-term retail investor mutual fund flows have actually been negative, these retail investors, who is not necessarily smart money, may try to chase the market in 2011. So we could see a reversal of fund flows, the possibility exists, and if we were to see a reversal of fund flows, the markets could head higher. US markets could head higher, which segue into the point when I was trying to make in terms of, will we see a continued flow of funds in the emerging markets versus developed markets? Another thing that could happen is that because emerging market countries are looking to high interest rates, right? Strong countries such as Brazil, when they have high interest rates, and Brazil right now has interest rate about 12.5%. Higher interest rates, local interest rates in some of these strong emerging market countries will actually attract capital. So we'll see funds flowing into a country like Brazil if their rates go up, which could actually, pressure yields lower. So there are containing factors. They have risk of reversal, but they also have the possibility that the action of trying to hike interest rates could actually see more hot money chasing after returns. The local backdrop, we went through that last week, but just to summarize the local backdrop, essentially Jamaica is facing a challenging situation. However, we have made a lot of significant steps. Our fiscal accounts are performing creditably. We have met all IMF targets so far. And we think that the government will come pretty close to meeting its last target for the quarter ending March 2011. GDP growth, however, has remained weak. However, we think that it's moving in the right direction. However, we don't think that GDP growth is going to go anything above 2 to 3%. And we need about 5% annual growth for like maybe the next 5-6 years to get us out of the slump that we're in. Debt ratio remains high. However, recovery in the US and hopefully global economy will actually spur improved economic activity for Jamaica in 2011. There is a plus going forward. Looking at interest rates, in 2010, JDX essentially resulted in a fall in interest rates. So the chart that we have up here is looking at the difference between what rates were at the JDX date versus where they are today. And essentially we have seen the entire yield curve shifting downwards. Importantly though, is the steepening of the yield curve that's really important. What do I mean by steepening of the yield curve? It means that the yields at the shorter end of the curve, such as 30-day yields, have been falling much faster than yields on, say, 10-year paper. Now, what does this mean? It means that, for example, yields on mortgage rates, etc., are not falling as fast as yields on money market rates, right? So, interest rate reduction in Jamaica is really being driven at the short end. To stimulate the economy, you really need long-term rates to fall, and we see whereby that's going to remain challenging in terms of getting them significantly down. Of course, the government is working on some policy initiative to facilitate, for example, transfer of mortgages and loans from one institution to another, which is one of the reasons why loan rates are not trending down at a faster pace. So what's the story regarding interest rates? What's the implication for investors? Well, the chart that we have up on the screen now essentially is telling us that the implication is that we're going to have negative real rates of return. And my prediction is for us to have negative real rates of return for the entire thing. So what do I mean by negative real rates of return? Is the rate of return after you take out, after you adjust for inflation and taxes, right? If you look at the chart, in 2010 we had roughly negative real rates of return. In 2011 we say we're going to have more of the same. The implication of negative real rates of returns is that we're going to have to look to how can we manage our portfolio to generate the type of returns that we need to keep our purchasing power. In other words, we're going to really have to take a serious look at transitioning our investment conversation from one where we're discussing just a rate to one where we're discussing what kind of performance, or what kind of returns our portfolio can do, and what's the risk that's involved in our portfolio. And I think that we need to start that conversation as investors significantly. Last week we showed you the real exchange rate, that is Daley usually adjusted for difference in price between Jamaican economy and US economy. And our charts our model is showing us that Jamaican dollar is overvalued approximately by approximately 12%. However, for 2011, we don't think that that overvaluation will mean that we have significant depreciation. Quite the contrary, we think that strong portfolio flows, plus multilateral flows, plus a recovery in some of our export industries, and central bank intervention, plus the fact that we have a pretty strong external current account, well, external net international reserves currently, that the exchange rate will actually remain in a band, in a narrow band. So we don't see significant depreciation in exchange rate. But what does that translate to for investors? What it means is that a lot of investors used to be able to depend on depreciation of US, J-dollar USD to bolster some of their returns. And our view is that in 2011, the ability to make significant positive returns from the depreciation of Jamaican dollar will not exist. It has a very low probability of occurring. So you're going to be making negative returns on the Jamaican dollar investment, cash investment, and negative returns on the US dollar cash investment. Therefore, the question is not one about rates. Because no matter what rate you want to argue about, you're going to be making negative real rates of returns on the portfolio. You have to think about a portfolio which will take on moderate amount of risk, but will generate a return that preserves your purchasing power. This chart basically shows you the performance of the exchange rate over the past 15 years. The only time that exchange rate actually appreciated was in 1996 prior to 2010. And it appreciated by about, I think, 13.5%. The year before that, it actually depreciated by 19%.